Hi, everybody. August 29th, the market update desk was Scott Riley, NMLS 157524. Wanted to do this afternoon's report on a deeper dive into the PCE report and also go into depth on Fed Governor Waller's interview on CNBC, which was very telling, kind of interesting. So, as we talked this morning, the Fed's favorite measure of inflation, PCE, the headline rose 0.2% month over month, which was as expected, and the year over year remained at 2.6%, right in line with the market forecast. The core rate, which takes out the volatile food and energy costs and really is the Fed's main focus, rose 0.3%. And that also was in line with expectations. The year over year rose from 2.8 to 2.9%, right on the dot of where the market had planned. Now, when we look at a shorter term data point, the 3-month core increased from 252 to 294, a little hotter than expected, but the 6-month run rate decreased slightly, and that's a good sign. Any decrease is good, from 3.09 to 2.95. Now, both these figures are down. Also, keep in mind from their February run rates of 4.1% and 3.4% restrictively. Something that is definitely skewing these numbers is the 5.4% rise in portfolio management. It's not really being talked about a lot. Now, this is now based on its weighting, it's raising the overall inflation by about 0.1%. We don't believe there's actually inflation from this because in most cases, financial advisors charge a management fee on their assets that are under their management, and that varies somewhere between 1% and 2% of the portfolio. Since asset prices have risen so much, specifically stocks and bonds over the last year, the total cost of that portfolio management as a percentage has increased in the term of in the data point of dollars. So that portfolio management is skewing these numbers a lot. But on the positive side, it means assets have grown significantly more than expected. Now, shelter cost, which is always one of those things we follow a lot, actually was pretty well behaved in this report. It rose 0.27% month over month and 4% year over year. Rents rose about 0.2%, while owner's equivalent rent, the OER, that's been very volatile lately, increased to 0.28%. Based on more real-time data, which we talked about with apartment lists and other data showing blended rates at 2.6%, the weighting of shelter within PCE year over year is being overstated probably by about two tenths. So between the portfolio management and the lag effect on shelter, we'd really be at about 2.6%, a much healthier place. Now, going forward, when we get the August report in September, we're going to have some headwinds because of another low replacement cost that we're seeing coming up. Now, personal income rose 0.4%, while spending rose 0.5, both also right in line with what we see. Today's report is not going to have a negative impact on the September 17th Fed meeting, and it basically came in at expected. Now, some very interesting comments from Fed Governor Waller. Now, he's one of the leading candidates for the Fed chair position next year. Now, he eloquently laid out his thoughts regarding the labor market, inflation, and monetary policy speech yesterday. He believes that after the revisions come in for June, let me go through my notes here. I took quite a few. In July, there'll be an outright job loss or a negative for the May to July time period. He also mentioned that thing we talked about quite a bit, the QCEW revision data that will be released September 9th, just before the Fed meeting. His thoughts are that there'll be a big negative revision and that the May to June also will see average further negative revisions of about 60,000 per month. That's a big number. He also brought up the concept of that many economists and Fed members have been speaking of. There is less demand in the job market, but also less supply. So that break even of how many jobs you need to be created to keep up with unemployment rate stable has actually fallen. Waller thinks the job market is continuing to weaken, and I really think he's correct on that, and pointed out the quit rates being at the lowest level since 2019. Business contacts are telling him that they're delaying hiring due to a couple different things: uncertainty over tariffs, absolutely, but also the threat to AI and rising teen unemployment. There's been a lot of talk about the response rates on the BLS reports being much lower than even just a decade ago, causing inaccuracies in the data. The BLS allow firms to respond over a 3-month period. Now, 10 years ago, not that long ago, the response rate was 95%. Total responses was 75% responding in the first month, 20% responding in the second and third month. Today, we're still getting the overall response of about 95%, but firms are reporting later. Today, there's only a 60% response rate in the first month and 35% over the second and third month. This delay in response, it leads to what we've been seeing: larger, bigger revisions. Also explained that bigger revisions can signal a turning or inflection point in the labor market, and he expects further weakening as we go forward. On inflation, Waller believes that factoring out tariffs, underlying inflation remains closer to the 2% Fed target rate. Also thinks that the neutral Fed funds rate is actually 3%, with the current Fed rate at 4.375. That means the Fed is being restrictive by 1.375%, or 137 and 3/4 basis points, and has a lot of room to cut rates and still be somewhat restrictive. Believes the Fed should cut 1/4, not 50 basis points, in the next meeting to catch up. So there's a lot of things going on there. This response rate, you're talking about this first, the first response going from 75 to 60% response rate. That is laying the groundwork for some of these inaccuracies we're seeing, the big revisions, and untrust within this BLS data. And it goes back to methodology that needs to be updated. So next week's a very big week. It's the second big data point leading up to the Fed meeting, September 17th. Monday, the market's closed. Wednesday, we're going to get the JOLTS report, mortgage applications. Thursday, ADP payroll and jobless claims. And then Friday, the BLS report. Now, the market's factoring a BLS report that's going to show 78,000 jobs were created in August, and the unemployment rate to tick up from 4.2 to 4.3. The main reason for that is because the actual reading for last month was 4.248, a whisker away from 4.38. So we're probably going to see a tick up on that. So on the technical side, mortgage applications are trending in a range of about 101.88, with overhead resistance hitting us at about 102.23. 10-year treasuries in a range of 4.288 to 4.2%. Yields, at least on their face, look to be poised to test the 4.20 marker again next week, if we get to break through that, which would be a nice thing. We keep bumping up against it. It's a brutal resistance level. We do have that room down to about 4.13 yields. So it's a holiday weekend. It means a great time for buyers to get pre-approved, get offers in, get accepted, working with your realtor that's on call, and your lender, me, that's on call all weekend. We'll help you get that offer accepted and get you closed quickly with the best loan program for you. Give us a call, 616-293-2189, the Market Update Desk, your original singular market news source for West Michigan.